This is Viewpoints by Hennessy, a podcast featuring the latest thinking from the team at Hennessy Funds. My name is Jay Coulter. Joining me for this episode is Brian Macauley, the co-portfolio manager of the Hennessy Focus Fund. We're going to discuss the current investing environment, including some individual stock ideas. Brian, it's great to have you on your first interview on Viewpoints by Hennessy.
Great to be here, Jay.
All right, let's dig right into it. After the chaos of the financial sector earlier this year, how do you look at the financial sector today?
Well, we invest in the financial sector, but our exposure is really through specialty financial companies that are doing something very unique, and we're really not exposed to traditional depository institutions that you're seeing in the headlines. And so our businesses tend to march to the beat of a different drummer than Silicon Valley Bank or Republic Bank. And so our interest in what's going on in the headlines in the banking sector is really to understand what is going to happen to the credit environment. The credit cycle is very important to the economic cycle, and most businesses rely upon that availability of credit to run their operations and have availability for growth capital and so forth. And so that's what we're keeping an eye on.
So how do you think the residential housing market is being impacted by all this chaos?
Yeah, so we own home builder NVR, and rising interest rates, widening credit spreads are making the cost of buying a new home higher. In addition, we've had really strong price growth in housing. And so housing affordability is very stretched right now. And so it's difficult for people to afford to get into a home. It also has resulted in a lot of existing homeowners that have very low interest rates, mortgage rates in their homes. And so they don't want to move. And so housing turnover is down, and new home builders, well, they don't have to move out of those homes. They're building them new. And so that's kind of the relief valve. It's been a pretty good environment for new home builders. Volume's down a little bit, but pricing is held in there, and margins are very high relative to history. So we're optimistic about the housing market and NVR.
So we're recording this in June of 23. Just this week, the Fed hit pause. How do you see the Fed decisions playing out going forward? And then how do you look at that as a portfolio manager?
So, Jay, we take a very long-term view in investing. We're making investment decisions with the idea that we're going to end up owning a business for the next 5, 10 plus years. And so, we don't spend a lot of time trying to forecast where the economy is going in the short term or interest rates in the short term. What we're seeing out there is, we agree that the pause is probably in place. And that allows businesses to adjust to this new higher interest rate environment. And we believe that our businesses, those 20 or so businesses that we own, are in a pretty good place where they're going to be able to recalibrate, and they're going to be able to continue to compound earnings per share and cash flow per share at a double digit, hopefully mid-teens rate that we're underwriting to.
Excellent. And I'm looking forward to digging into the fund. Before we get there, though, the market has done pretty well this year. Do you feel that we've entered a new sustainable bull market?
Jay, that's a really hard one to figure out. The market's done well overall, but if you look at the breadth in the market, it's quite narrow. Really, the top 7 stocks have delivered all of the net gains for the market this year. And the remaining, in the S&P 500, 493 names have delivered net zero return. And so this is not a broad-based rally. So it's not that indicative to us as to whether, this is a new base that we're building off of, or whether we've got some further digestion of higher interest rates to happen.
Well, so a great dovetail question there into volatility. When you look at market volatility, really over the last couple of years into this summer, how should you investors and portfolio managers look at that?
So the way that we look at volatility is we view it as an opportunity. As a long-term investor, again, a 5 or 10-year investment horizon that we're looking at, we see volatility as a chance to buy great businesses at discount prices. Or on the flip side, to sell businesses that are maturing and are pretty fully valued and recycle capital into other more attractive opportunities. So we don't get too worked up about, what's happening in prices on a daily, weekly, or monthly basis. We just take that as part of the, part of the turbulence as being a public markets investor.
Yep. So you were recently quoted in Business Insider, and I'm going to read it because I'd like your comments. You said, investing in public markets is very, very competitive. And in order to be successful, you need to find an edge. And our edge is in knowing the businesses extraordinarily well. Could you put some context around that and tell viewers, what did you mean?
Yeah, thanks, Jay. So we think that, again, we're in a very competitive business. There are lots of smart people with lots of resources available to them trying to understand and forecast stock prices and businesses. And so what we do at the Hennessy Focus Fund is we concentrate our capital in our 20 best ideas. And we take this long-term view, about a 7, 8, 9, 10-year average hold period. And so each year we're making on average about 2 new investments. That means that we could be very selective in the types of businesses we choose to invest in. We can conduct significant fundamental research on those ideas and be patient looking for the right entry and exit points. We think that having to only pick about 2 new investments per year, in contrast to the typical manager that's making 25, 50 plus investment decisions per year, really puts us in a position to make intelligent decisions that serve our shareholders well.
It's a great segue into the Hennessy Focus Fund. Clearly a focus strategy with low turnover, but from a high level, what is the investment process that you guys use with the Hennessy Focus Fund?
Yeah, Jay. So we try to have a rigorous, repeatable process in making investment decisions. We have a sequential research process. If we find an interesting business investment opportunity, we conduct what we call a shallow dive, which takes about 10 hours worth of research time. If it passes through the shallow dive gate at our investment committee, and only about 10% of businesses do, then it goes to a medium dive where we're spending 50, 80, 100 hours researching that business, really getting to know it and getting to understand the industry dynamics. If it moves through the medium dive stage, it goes to a deep dive. And a deep dive is where we think we do the real value added research. We're out there, we're talking to former employees, private competitors, industry consultants, trying to get a 360-degree view of this business and validate or invalidate the investment thesis that we have. We think that fundamental research positions us well to make these smart decisions and add value to the fund and for the shareholders. So
what are the risk controls that you use in this portfolio? The things that would cause you to remove a security?
So we are focused on risk as the permanent loss of capital or impairment of principal. Risk to us is not price volatility in the short term. Risk is you invest $100 today, and you get back something less than $100 in 3, 4, or 5 years' time. And so the most important risk control for us is to make really sound decisions on the individual businesses that we select. So we're trying to pick businesses that are leaders in their space, that have great management, that have some tailwinds behind them, that are reasonably priced, that have conservative balance sheets, so that any individual investment is unlikely to go backwards in some material way over the intermediate term. When we roll up those individual investment decisions to the portfolio level, we're just trying to build adequate economic diversification across the portfolio so that we've got 20 discrete bets, 20 discrete investments to provide diversification in the fund.
Let's talk about some of those investments today. So you currently have a position in Warner Music Group. Brian, what is the investment case for Warner Music Group?
Warner is a relatively new investment for us, and it's one that we're pretty excited about. Warner is one of the top 3 providers of recorded music in the world. Along with Sony and Universal Music Group, those 3 control about 70% of all recorded music in history. And they've got licensing rights to it. And those licensing rights are of increasing value as streaming services such as Spotify, YouTube Music, and Apple Music gain traction. Here in the US, lots of folks have those services, about 40% of the population. But as you look more broadly around the world, there's a great deal of increased adoption that there's to occur over the next decade. So we think that growing streaming music service is going to increase profitability at Warner Music Group and the whole space really at a nice clip. We think we'll see about 10% revenue growth per annum over the next decade with some margin expansion, some share repurchases or dividends, and that should get us close to a mid-teens rate of return in this business over the long term. For that opportunity, we need to pay roughly a low 20s multiple of earnings today.
What is the investment case for Encore Capital Group?
Encore is a buyer of charged off credit card receivables. And so if you don't pay your credit card bill after a couple of months, the credit card company will try to tighten the screws a bit and work even harder to get you to pay. If after a few more months you still haven't paid, they'll stop trying to collect and they'll just sell that receivable to somebody like Encore. In the US, there are really only 2 large credit card receivables buyers, Encore and PRA. And so it's a duopoly, so to speak, in buying these receivables. Encore has gotten very good at it, and there are barriers to entry so that new folks have a difficult time coming in because of scale, because of regulatory burdens to operate in this business. And what's going on is that this is really a counter-cyclical business. And if the economy gets worse, more people are going to have a difficult time paying their credit card bills. There are going to be more receivables that go into delinquency, more sales of those receivables. The supply available to Encore will increase. Encore will get better prices on that paper that they buy, which means that they're going to generate really high returns when they try to collect on those receivables after they own them. And so we think the business today is trading about 6.5 times earnings this year. And we believe this is the trough year for earnings. We think that as the economy gets tougher, as student debt deferment ends in the 3rd quarter this year, we're going to see increasing charge-offs, and that could send earnings over the next several years at Encore up 2 or 3-fold from a very modest starting multiple today.
So, Brian, what is the investment case for CarMax?
CarMax, as you probably well know, is the largest used car retailer in the United States. They have a very unique value proposition of no haggle pricing, wide selection, and excellent service. And, CarMax is a business going through a cyclical downturn now. But this is a growth company in, a cyclical end market. And so because there was a boom in vehicle sales, and now interest rates have risen, new and used vehicle prices are affordability is quite low now. And so that means that there are fewer vehicles being sold, which is bad for CarMax and their relatively fixed cost basis. Industry-wide, about 35 million vehicles will be sold this year, and that compares to about 40 million vehicles over the long history of the auto industry over the last few decades. And so we're well below normal levels of used car transactions, which means that CarMax is under-earning what they would normally earn. We think they'll earn about $2.50 or $3 earnings this year. But in a more normal environment, 40 million units sold in the industry, they'd earn closer to $6 or $6.50 per share. In addition, that earnings power is growing as CarMax continues to gain market share, as they roll out their omni-channel solution, as you're able to buy vehicles from them online, in the store, or some hybrid solution in between. They're just further distancing themselves from the whole slew of used car vendors out there. And so we think that as we look out 3, 4, 5 years, this is a business that's very likely to deliver close to $10 of earnings, with the stock price at about $80 per day. we think that that presents a great opportunity.
What is the investment case for the Ashtead Group?
Ashtead is the parent company for Sunbelt Equipment Rentals. Sunbelt is the second largest equipment rental company in the United States, second behind United Rentals, a business that you might be familiar with. They rent equipment to construction contractors and to industrial companies and a variety of other end markets. So what's exciting about this opportunity is that there are important benefits of scale in this industry. Scale allows you to buy equipment more cheaply from the equipment manufacturers, but even more importantly, it allows you to, if you've got scale in a region or a market, to have more equipment inventory there. And so when a contractor calls up and says, hey, do you have this piece of equipment and can you get it on my site, tomorrow morning? You can say yes. And so as the leader in a market, you have tremendous benefits and positions you well to gain market share. Ashtead has about 12% market share today, up from about 6% market share 8 years ago when we first made the investment. And we believe that there's a glide path to well north of 20% market share as we look out, a decade plus. This is a very profitable business with high returns on equity and capital. And we think that over time, as that share grows, their earnings grow, it's going to create a lot of equity value for shareholders.
Excellent. Brian, thank you so much for coming on Viewpoints by Hennessy. To learn more about the Focus Fund, please visit HennessyFunds.com. That's HennessyFunds.com.
Thank you, Jay.